Hello fellow intelligent investors, my name is René Zellman and today I want to continue to talk about valuation methods. In this video I will discuss the advantages and disadvantages of a relative valuation approach, a tool that is used by many market professionals and analysts. I will first explain two different types of relative valuation and then share whether I think this is a viable and effective tool to value companies or assets in general. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman and I'll teach you how you can manage and invest your money with confidence, a long-term vision and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Now before we get started, I just wanted to point out that this is actually the second video of my video series on different valuation methods. In my first video I discussed valuation multiples and their limitations. And in future videos of this video series I will outline the discounted cash flow method, an exit multiple DCF as well as a probabilistic DCF. So if you want to learn more about these valuation techniques, be sure to hit the subscribe button and the notification bell. Alright, so what is relative valuation? Well, put in a nutshell, I would say that while absolute valuation approaches, and maybe the discounted cash flow method in particular, examine the intrinsic value of a cash generative asset without comparing it to other comparable assets, you are essentially evaluating the asset on its own. Relative value is based on the value of similar assets. The objective is to value an asset based upon how similar assets are currently priced by the market. I guess we can best illustrate the idea of relative valuation, which is also referred to as comparable valuation, with the world of real estate, because in a way relative valuation forms the framework for valuing properties. Sure, real estate represents a productive asset, a cash generative asset, and therefore an apartment or house possesses an intrinsic value. Yet, anyone who has ever considered buying a house will have noticed or understood that figuring out the price of a house always integrates the value of other and nearby properties that have recently been sold maybe. If an identical house right across the street sold for $1 million last week, it's unlikely that you will be able to buy a neighboring house of the same size that looks pretty much the same for half the price, so for $500,000. And similarly, if you want to buy a specific baseball card, you might check out on eBay how much other sellers are usually charging for this card and then decide whether the offer, let's say a friend made you, is attractive or not. Now there are many other asset classes besides real estate and baseball cards. Companies, so stocks, are assets too, and that's why one can apply the idea of relative valuation to companies as well. As we have said, relative value is based on the value of similar assets. And so if you use relative valuation approaches to value an enterprise, a company, you evaluate a company relative to its peers, relative to companies with a similar business model or similar business operations. Usually, those are peers or direct competitors, or companies that are at least operating in the same or related industry, companies of the same size, quality and growth. And how can you compare companies? Well, you can do it with the help of the valuation method we discussed in the first video of this video series, with the help of valuation multiples. The logic is that if similar companies are 10 times earnings, then the company that you try to value should also be 10 times earnings if it is operating in the same industry and is possessing similar characteristics. So what analysts like to do is they will put together a table, or maybe sometimes multiple tables, in which they compare the valuation multiples of similar companies. They might use earnings multiples, revenue multiples, book-to-value multiples, or free cash flow multiples. They might also use sector-specific multiples, such as, for instance, EV to gross merchandise volume, in short GMV, to compare online retailers. Or back in the .com bubble, analysts might have compared companies based on the number of clicks per month to decide how promising an online company was. And in addition, analysts might also compare other metrics, such as margins, returns on invested capital, past or forward-looking growth rates, or sometimes they actually like to compare the multiple of a specific company to the average of that sector or industry. And if you consider the following table, for instance, analysts would argue that company E is undervalued relative to its peers and that the market is not recognizing the full potential of that company yet. The market is not yet recognizing the inherent qualities and maybe the growth prospects. Or if you consider this table, then analysts would possibly argue that company E deserves to trade at a premium price, a higher multiple, as higher margins and growth demonstrate superior business quality. And if you want to understand why analysts love to use relative valuation methods, despite the limitations that we will talk about later on, I highly recommend the following article by the NYU Stern University that explains why this approach is so popular among analysts. I'll add a link to the article in the description box below. Now, those are obviously fictional tables to illustrate how relative valuation works, but you can find similar real-world tables on financial websites such as Seeking Alpha. Just take a look at this chart in which the valuation ratios of Bayer, a pharmaceutical company, is compared to the sector median. We can also consider this chart in which Bayer is compared to its peers, other pharmaceutical companies. Similar tables can also be found on a website called Ticker, which even allows you to compare Bayer to either pharmaceutical, chemical or biotechnology companies. Or you could also use QuickFS. Simply open two tabs and then compare the key metrics of companies such as Visa and MasterCard, for instance. Now, this is only the first form of relative valuation. Another form of relative valuation would be to compare the current valuation multiple of a company to its long-term historical averages. You could then decide whether the current valuation is high or low relative to its history. For example, the following graph provided by macrotrends.net shows that Apple's current PE ratio is relatively high compared to the previous 15 years. You could do the same with Apple's price to free cash flow ratio or the technology company's price to sales ratio. Again, I can also recommend the service of Ticker, which offers the same function but many different valuation ratios. Now, in the first video of this video series, we have stressed that all valuation methods that we will talk about have some major limitations, and that it's important that investors acknowledge these limitations. So obviously the relative valuation approach has some weaknesses too. I think while relative valuation is fairly easy to use and quite intuitive, it's also easy to misuse this approach. So the first difficulty is finding two comparable companies. While real estate agents can probably find two houses that are very similar in terms of location, size, bedrooms, and so on and so forth, finding two companies that are almost identical is usually much harder. So this makes the relative valuation approach already somewhat artificial, I would say. Think of Apple, for instance. Can you really compare the Cupertino company to the companies listed in the competitor section of Ticker? To be honest, I doubt it. They differ in terms of balance sheet strength, maybe management qualities, growth potential, target group, pricing power, or maybe lastly optionality. And on Investopedia I also found the following paragraph that showcases why McDonald's cannot necessarily be compared to other restaurant companies. The authors wrote the following. For example, relative valuation may not be a good idea to use between McDonald's and Darden. While both are restaurant companies, McDonald's is a fast food concept, while Darden operates more formal sit-down concepts. Both are involved in the food business, but they offer a different concept at different price points. As such, comparing margins or another ratio would be ineffective since the business model is different. As I have pointed out in my intrinsic value video that I referenced earlier, I think a relative valuation approach is by far the worst valuation method that I will mention in this video series. In my view, it is clearly inferior to the other methods that I will discuss. Now, of course, you could try to make sure that the two businesses you are comparing are as similar as possible. For instance, one might argue that Visa and MasterCard have a very similar business model and that it's worth comparing the two companies. Or you could simply compare the current valuation of a company to its historical average. But I think there's another problem. The second major flaw of relative valuation approaches is that analysts simply assume that if a stock is cheap in comparison to its peers or its own history, it is therefore also cheap in an absolute sense. But this is simply utterly false if you ask me. Nothing could be further from the truth. And to stick to our real estate analogy here, let's say you have a real estate agent that offers you a 1-bed, 800 square feet apartment in Omaha, Nebraska, which is one of the most affordable cities in the United States. And he offers you that apartment for $2 million. Do you consider the apartment cheap just because similar 1-bedroom apartments in that neighborhood trade for similar prices? Obviously not. Similarly, industry valuation multiples may be above historical norms and might also not reflect the future growth prospects of that industry. Say both Visa and MasterCard are trading at excessive levels. This does not necessarily mean that if one of the companies has a lower PE than the other, that it is necessarily cheap in absolute terms. And just because a company is cheap compared to its own historical averages, this does not necessarily mean that the historical averages were not already high. Or similarly, just because a company's current valuation multiple is above its historical average, that doesn't necessarily mean that the company cannot be cheap in absolute terms. In fact, I believe that relying too much on relative valuation might expose you to the so-called anchoring bias. The business and its growth trajectory might have changed, and therefore the business might deserve to trade at a higher multiple. All of this is not reflected in a relative valuation approach. And lastly, I wanted to point out that relative valuation approaches are actually vulnerable to manipulation. In the aforementioned NYU article, the authors wrote the following: a biased analyst who is allowed to choose the multiple on which the valuation is based and to choose the comparable firms can essentially ensure that almost any value can be justified. So, put in a nutshell, you are primarily relying on the fact that the market always knows how to value businesses correctly if you rely on relative valuation approaches. But everyone should have realized in 2020 that the market is not efficient. Relative valuation approaches tell you where a company trades at today in comparison to its peers or its historical averages, but it does not tell you what a company is worth. As a result, a stock may be undervalued on a relative basis, but overvalued on a discounted cash flow basis if the firms used for the comparison and the relative valuation approach are all overvalued by the market. And of course, the reverse could also be the case. So in our next video, we will focus on valuation methods that help estimate the intrinsic value of a business by looking at only the company on its own. The most common intrinsic valuation method is a so-called discounted cash flow method, in short DCF, which isn't concerned with how other companies are valued. This method is certainly more time-intensive and it requires substantially more information than relative valuation approaches. It also requires true qualitative analysis and judgment, but it is certainly a superior valuation method. While valuation multiples and relative valuation approaches are likely so popular because of their simplicity, a DCF might actually give you an edge in the market if you develop a very good understanding of the individual business and its growth potential. And this brings us to the end of this video. If you want to learn more about other valuation methods, make sure to subscribe to my channel and click the notification bell. And as always, may your finances and investments prosper. Good luck.